Let's go ahead and get into crypto tax compliance, and it remains a minefield as the IRS leaves key questions unresolved. This is coming from CoinDesk. Lack of guidance on everything from staking rewards to NFTs means there's a certain amount of guesswork involved in tax filings. This piece is part of CoinDesk's Tax Week. The old saw about taxes being one of life's two certainties is only partially true for crypto investors in the United States. While there's little argument that gains and losses associated with cryptocurrency transactions are taxable, there is little certainty about which taxes apply to different kinds of transactions and when. Rob Garver is a longtime Washington, D.C. journalist who has written for American Banker, Fiscal Times, Voice of America, and ProPublica. While some U.S. regulators, such as the Treasury Department's Financial Crimes Enforcement Network, FinCEN, and the Securities and Exchange Commission, the SEC, have tried to be proactive in providing guidance to the industry about how they plan to treat crypto assets, the International Revenue Service has so far offered relatively little guidance on some of the most pressing issues facing investors and traders. Tax policy is by far the area of U.S. policy that's the furthest behind as far as having sensible, easy-to-follow rules for people in the space, said Peter Van Valkenburg, Director of Research at industry lobbying group Coin Center. We saw much earlier guidance from FinCEN on anti-money laundering policy, much earlier guidance from the SEC on initial coin offerings. The IRS, when it has issued guidance, it has been basically late, perennially late. I don't know why I can't do that today, but it's par for the course. And that guidance has generally been more confusing than helpful. The IRS did not respond to a request for comment for this story. Kristen Smith, the executive director of the Blockchain Association, put it a tad more diplomatically. Quote, "This is a very fast-moving space, and the IRS and Treasury Department have been trying to wrap their heads around it," end quote, she said. The agency was actually ahead of other regulators when, in 2014, it offered guidance that classified convertible virtual currency, the Beltway term for what most people call crypto, as property. However, progress has stalled since then, and the issue has begun piling up. Smith said the industry generally thinks the IRS is operating in good faith, if more slowly than most would prefer. Quote, "These are obviously people that don't have deep crypto backgrounds," end quote, she said. But I think they have taken a lot of effort to try to understand the space. Congress getting involved in taxing crypto. If the IRS is moving slowly out of an abundance of caution or at worst bureaucratic inertia, that may be preferable to the alternative, as evidenced by what happened when members of Congress pushed crypto-related language into the bipartisan infrastructure bill that became law in November. I actually am not sure it's bipartisan. I just want to say that. I want to go on the record saying I don't think that bill was bipartisan. But in an effort to bring in more tax revenue from crypto traders, lawmakers created a requirement that cryptocurrency brokers report their clients' trading activity to the IRS. Unfortunately, the legislative language was drafted quickly and with little input from the industry, leading to a definition of broker that is so broad that industry representatives warned it could encompass wallet software developers and even cryptocurrency miners. However, as you guys know, we reported on this before, crypto miners in particular are now exempt from these reporting mechanisms. They no longer have to report, the users of the transactions that they validated. So we don't have to do that anymore. Also, it's physically impossible for us to do that as miners. So it just goes to show that there's a complete lack of understanding and research being done by the federal government in the United States on cryptocurrency. They have no idea what they're doing. All right, that's just the plain fact of it at this point. The Treasury Department will have to draft implementing regulations before the law goes into effect in 2024. And in doing so, it could narrow the range of entities that qualify as a broker. In a letter to lawmakers made public February 11th, the agency appeared to signal that crypto miners and stakers, at least, will not be considered brokers under the pending rule. Quote, I don't think that the intention of the law and the IRS is to capture miners, for example, or stakers, said Omri Marion, a professor of law and the academic director of the graduate tax program at the University of California, Irvine School of Law. However, he said it would be a useful sign of goodwill for the IRS to reach out to the crypto community during the rulemaking process. Quote, I think that mostly what is needed there is to lower the tension a bit and explain who is and isn't the broker for reporting purposes. Some members of the Congress have signaled that they understand that the industry's concerns and are open to passing new legislation that would limit the definition of broker to an actual cryptocurrency exchange that facilitates transactions. However, given the deep divisions in Congress, it is unclear what the chances really are of such a bill passing. Wait, crypto is cash now? The same infrastructure bill that created the broker reporting requirement added another twist to the government's tax treatment of cryptocurrencies. After years of being told their Bitcoin and Ether are property and not currency, the new law created an exception. Under existing law, any person engaged in trade or business who receives $10,000 or more in cash in exchange for goods or services is obligated to report that transaction. The report, which includes identifying information about the individual who made the payment, goes to the IRS and FinCEN. The new law classifies cryptocurrencies as cash for purposes of that reporting requirement. Because of the way the law is drafted, reports on crypto transactions of more than $10,000 would only need to go to the IRS. But that hasn't made industry participants any less concerned about the effect it could have on some sectors of the cryptocurrency space. The problem is that in many cases, cryptocurrency transactions are functionally anonymous, meaning the individual of the receiving end of a transaction may not have access to the kinds of personal identifiable information about the sender the IRS wants to collect, or vice versa. And it should stay that way. And we're going to be talking about the push now. I think what you're going to see is a realization of the governments and the banking system, traditional financial institutions, that they can't control everything within cryptocurrency because of the nature of decentralization, which is what we're pushing to. And so at that point, what they're going to try to do is discourage any type of self-custody, etc. Example coming up in the next article. Additionally, many crypto transactions take place under circumstances that make it very difficult to assess who could be responsible. There we go. And if a smart contract running on a decentralized exchange accepts $10,000 worth of Bitcoin, who would file that report? One of the perennial frustrations of people who would like to use cryptocurrencies as a medium of exchange is the tax treatment of the virtual currency as property. Means that virtually every transaction, no matter how small, amounts to a taxable event. When someone holding Bitcoin uses it to make a purchase, the IRS views the transfer of Bitcoin from the buyer to the seller as a disposition of an investment, triggering capital gains taxes. Even the mining fees incurred when transferring Bitcoin between the two wallets held by the same individual are technically taxable, and that's under the income tax rule. Some, just for a note for you crypto miners out there, some, like Kirk Phillips, a certified public accountant and managing director of Global Crypto Advisors, say the administrative burden of tracking even the tiniest of transactions are standing in the way of cryptocurrencies becoming a more widely used medium of exchange. Quote, there are definitely people who have changed their behavior based on how it ends up getting taxed and having to go through the compliance gauntlet, he said. It's a major headache. There is a bill before Congress that would create what's known as a de minimis exemption for small transactions. The Virtual Currency Tax Fairness Act, sponsored by Republican Susan Susan Delbene of Washington State, a Democrat, let me get that correct there for you guys, would exempt from capital gains taxes all crypto transactions in which the capital gains realized is under $200. So let's see, sponsored by her would exempt capital gains taxes. So that's a good move. Got it. However, despite the fact that the bill has broad support in the crypto community and has bipartisan backing in the House of Representatives, its chances of enactment are unclear. This is the third Congress in which the bill has been introduced, and to date, there is no similar legislation pending in the Senate. Whew. Taxation and staking rewards. One of the more pressing issues facing the industry, given the increasing preference for proof of stake mining, is how staking rewards ought to be taxed. Let me give you an idea. You tax it like you do the miners. You greedy mother. And if you don't, then you reverse the way you're taxing miners. God dang, you greedy stakers. The basic question is whether the cryptocurrency that a validator receives a reward for appending a block to a proof of stake blockchain is taxable as income when it is received. Historically, yes, any validation on the blockchain has been charging the miners. Oh, it makes me so mad. As an income tax, stakers are no different. Or whether there is no taxable event until the validator disposes of the currency. In a lawsuit filed in Tennessee, Joshua and Jessica Jarrett, we reported on this last week, a couple who run a validator on the Tezos blockchain, sued the IRS over taxes paid on staking rewards earned in 2019. The Jarretts argued that his receipt of the rewards ought not to have been considered a taxable event. Rather than fight the case in court, the IRS offered early this month to refund the taxes the couple had paid, though without offering any clarity on how it would treat staking rewards in the future. The Jarretts rejected the offer in a move aimed at forcing the courts to resolve the question of how to treat staking rewards. Hey guys, you had to pay income taxes. We've been doing it for years. So either if this goes all the way through and they decide to change the way they treat staking over mining, mining has to be included in this. And then all of us as miners have to go sue the IRS for all of our income taxes we paid on mining for the past, whatever. I'm 6 years in. How far in are you? Because that's going to happen. All right. The resulting situation is a representative of much of the tax treatment of crypto transactions. In the absence of clear rules from the IRS, individuals are having to make the best guesses about how they think the agency will treat different transactions. Quote, I am only dealing with a limited number of taxpayers, but I don't know of anybody that's actually withholding on staking rewards, said Lisa, a partner of the Washington office of the law firm Steptoe and Johnson. If the IRS position is that they should be subject to withholding, I don't think it's happening. She said that in general, taxpayers she works with are making a good faith effort to comply with tax laws by reporting income when they believe it makes sense to report it. This could all hit the fan if the IRS starts auditing these transactions and taking positions that are different from what taxpayers are taking, she said. Then it could have a stifling effect. However, she said that as a practical matter, it seems unlikely the IRS would implement some sort of retroactive crackdown that would penalize people who report income in a way the agency subsequently determined to be incorrect. I would be surprised if they started imposing penalties on people because they didn't comply, because there were no rules to comply with, she said. What they're more concerned about are non-reporters, people who aren't reporting their income from crypto transactions at all, below the radar. While there may not be much clarity on the tax treatment of staking rewards, at the least, the crypto community can feel confident the issue is on the IRS radar. The same can't be said for multiple other issues. Consider, for example, the market of non-fungible tokens, NFTs, which reached more than $44 billion in sales in 2021, according to the blockchain data firm Chainalysis. A large segment of the market is made up of pieces of digital art or the bragging rights thereof. While new collectors may be content for the time being to stare at their digital galleries of Bored Apes and hash masks, eventually many are going to want to sell their NFTs or get them stolen on OpenSea. You know what I mean? You know what I mean? When that happens, how the IRS will treat any profit they realize is an open question. Regular long-term capital gains taxes in the U.S., which apply to the sale of investments held for more than a year, max out at 20%. But there is a special carve-out for property classified as collectibles, a category that includes fine art that tops out at 28%. So NFTs top out at 28%. It's the same. That's how I see it. To date, the IRS has been silent on the question of whether NFTs ought to be treated as collectibles, creating the disconcerting possibility that the question of whether NFTs constitute real art might be determined in tax court. Another area where existing rules are creating confusion is around the tax status of individuals who trade cryptocurrencies for a living. Under the law, an individual who buys and sells stocks and securities can claim trader status when they file their taxes, allowing them to deduct business expenses from their trading gains and offering a number of other benefits. The problem, said Shannon Sheehan, there we go, Chandraskera, I can't do that, boys. Head of tax strategy at cointracker.io, a portfolio and tax management service, is the statutory language appears to limit trader status to individuals who sell stocks and securities, not property as crypto is classified. Quote, for people who are legitimately day trading cryptocurrencies, the question is whether they should rely on those code sections that are written for stocks and securities to get those tax benefits, end quote, he said. Because if you can get that trader status, that's going to save you so much money in taxes. They struggle because it's only applicable to stocks and securities, but at the same time, it's unfair for them to not get that treatment because they're actual traders of cryptocurrencies, except that they don't want individual financial autonomy. Look, even if you Google financial autonomy, you never see financial autonomy applied to the individual on Google. That is the thing that no government, governing body, or traditional financial institution wants you to know that you can possibly obtain. And what helps you obtain that is cryptocurrency. And these kinds of policies and the way they're playing with it, the reason they're not sure is because they want to figure out how they can control that and take away that individual autonomy from you. That's what they want to do. This neither here nor there status for crypto traders is analogous to the tax treatment of crypto assets more broadly. It's a situation that frustrates advocates pushing for more clarity from the government, especially because it contributes to the impression the crypto space is a sort of Wild West where the normal rules don't apply. There's a myth that crypto people don't want to pay taxes. Coin Center's Van said, I think the vast majority of people in crypto, just like the vast majority of Americans, just want clear rules to know what their tax obligations are so that April isn't a nightmare. Yes and no. So we don't want to pay exorbitant taxes, right? But we do want to know what's expected. Look, even if you disagree with something, like let's say you disagree with a law, right? There's plenty of those laws that are out there, or whatever they may be. At least you have a law to where you understand what you can and can't do, right? Like in California, I know I can go into a store and steal $900 worth of stuff and I'm free and clear. Steal $901 worth of stuff and I can go to jail. There you go. Clear law. I understand where the lines are drawn. Just give us the laws, right? Freaking mad world up in her. So that pretty much covers the tax topic for the week. From the miner's perspective, we are going to be reporting income taxes, mined cryptocurrency as income. Because of the case with the IRS and the staking rewards of that couple, it should be noted that essentially, depending on how this gets pressed when it goes to court, if that gets overthrown, then it needs to be overthrown for miners. End of story, period. And all the miners need to sue for back taxes for the past, since the inception of cryptocurrency mining. That's what has to happen. And they need to return all of that money to us. End of story. End of story. All right. I hope you enjoyed this clip from the Crypto Mining Morning Show every Monday through Friday, 7:45 a.m. Pacific and 10:45 a.m. Eastern Time. You can check out more clips here, or if you're interested in checking out the entire live show, you can check that out down here. Thanks for watching, and I'll see you next Tuesday.